Imagine you want to buy insurance for two cars. One is driven by your grandmother, the other by a Formula One driver. One is driven once a week just for grocery shopping. The other is driven every weekend by someone who races on a track. Which insurance policy do you think costs more? Obviously, the second one. Not because the insurance company knows there will be an accident, but because they expect there's a much higher chance of one. Options work in exactly the same way. So here's the real question. If higher volatility makes options more expensive, should you buy options when volatility is low, or should you wait until volatility is high? The answer depends on one thing. Are you buying options or selling them? The market doesn't know whether a stock will go up or down, but it does estimate how much it could move. And that expectation is called volatility. Think about it this way. If the market expects very little movement, there's a lower chance that an option will gain significant value. Because of that, buyers are willing to pay less and sellers are willing to accept less. As a result, option prices fall. But now imagine something changes. Earnings are coming next week, or an important economic report is about to be released. Suddenly, nobody knows what will happen. The market now expects a much bigger move, not necessarily up, not necessarily down, just bigger. And because there's now a greater chance that the option could become much more valuable, buyers are willing to pay more and sellers demand a higher premium. Volatility doesn't tell you where the stock is going. It tells you how much the market expects it to move. Let's look at a simple example. Imagine a stock has been trading quietly for weeks. Every day it moves just 1 or 2%, nothing unusual. The market doesn't expect any major surprises. Because of that, option prices remain relatively low. Now imagine the company is about to report earnings tomorrow. Suddenly, nobody knows what will happen. The stock could jump 10%, it could fall 10%. The direction is uncertain, but everyone expects a much larger move than usual. And that's exactly what volatility measures. Not the direction, the size of the expected move. Because that expected movement has increased, buyers are willing to pay more for options. At the same time, sellers know they're taking on more risk, so they demand a higher premium. As a result, option prices rise. In the trading world, this is the difference between historical volatility, what already happened, and implied volatility, which is what actually sets the price based on the future. So, does that mean high volatility is good? Not necessarily. It depends on whether you're buying or selling options. If you're buying options, lower volatility generally means lower option prices. You're paying less to enter the trade. If you're selling options, higher volatility generally means higher premiums. You're getting paid more for taking on that risk. That doesn't mean you should always buy when volatility is low or always sell when it's high. But understanding this relationship gives you a significant advantage when choosing your trades.